Right, hello. Today what we are looking at is we are looking at this notion of risk aversion. Okay, and so when we talk about risk aversion, that is averse, right, to risk, meaning we want to avoid risk. Okay, so one of those things we're looking at today is we're going to use this example of RadioShack. Okay, RadioShack was a really big company in the 1980s and the 1990s. It was a place where we went to go get all sorts of things that we need. RadioShack recently has had a little bit of difficulties, okay? So when we're looking at this and we're talking about risk aversion, one of those things might be is that when we feel this company is really, really risky, we might run away. We might not even want to touch it, okay? And so what we're going to be evaluating today is looking at what happens to that stock valuation when there's a change in our perceived risk of that company, okay? So this is a news story right here, which is showing about RadioShack's stock price. Okay, and we see it was crushed today ahead of possible bankruptcy. Okay, so there's this notion, hey, this company might go bankrupt, and if this company goes bankrupt, then my value as a stockholder is going to go to nothing. Okay, so bankruptcy is kind of a big deal. Okay, and so the stock price went down. We kind of understand that, yeah, bankruptcy is going to go down, but why exactly is it going to go down? Using the tools that we've looked at thus far is we're going to be able to look at this using CAPM. Okay, so that's the notion here is CAPM under the threat of bankruptcy. Okay, so I just want to point out here is so we're saying it's down 27.4% when some news came out, right? Because people found out, hey, this company might be going bankrupt, so let's not buy it. Let's get out of this stock. Okay, so we're going to start this discussion by looking at another company. Okay, we kind of know that RadioShack is not a great business model any longer. There's a lot of other places where we can get this stuff. They're smaller stores. They don't carry a wide variety of things. They have cell phones. They might have computers. They might have this other stuff. But there's a lot of other places we can get this. Okay? So one of those things that I would look at and I want to start off this comparison with is that I don't shop at RadioShack anymore. I haven't for a long time. Where I do most of my shopping is at this company known as Amazon. Right? Amazon.com is a great place if you have Amazon Prime. Not trying to advertise here, but Amazon Prime is, right, you get 2-day free shipping. You spend like $70 a year. It shows up at your house. You don't even have to get up and go to the store. And their prices are going to be lower than RadioShack anyway. So it's natural that places like this are going to put RadioShack out of business. Other stores like Walmart, like Target, those big box stores are going to be pushing those smaller stores out. Okay, so RadioShack doesn't have the competitiveness in the sales. So when we're looking at CAPM, right, is that we want to look at that rate of return is equal to the risk-free rate plus beta multiplied by the risk premium. Okay, and remember that risk premium here is that this is the equity risk premium. This is the overall market. Okay, so what do we think the overall market's going to do? Now, when we find out the RadioShack might be going bankrupt, the overall equity market is not going to change, right? Because that is what we call idiosyncratic. It's just an individual stock that's having difficulties. It's not the overall market, okay? So here, the overall market, it's remaining constant. Where the change is going to happen is going to be in beta, okay? That's where the change in bankruptcy will occur. All right? So it's going to be the risk-free rate and the risk premium are going to remain constant. And so what do we think is going to happen when this company when RadioShack is about to file for bankruptcy? Okay, so we're looking at here is Amazon. Think about that question. What do you think is going to happen to beta? Okay, so with Amazon, right, Amazon has a beta here of 1.4. Okay, what do we know about beta? 1 is going to equal the market. As we go higher and higher, we know that the beta is going to increase, thus leading to a higher required return. Okay, so now looking at the Gordon growth model, right, which the price level is equal to D1 divided by R minus G. Okay, so if R increases, if R rises, what has to happen to the whole thing? This whole thing, the whole price has to drop, right? So when R goes up, the price level falls, right? When the required return rises, the price level ends up falling, okay? So that's what we are going to end up seeing here. Now, how we get there, right, is that when we have an increased beta, that's going to lead to an increased required return, right? We need a better return on RadioShack because we think they're going to go bankrupt. And then that's going to lead into a lower price, okay? So we're going to compare this to another one of RadioShack's competitors, right, which is Best Buy, okay? Do we think Best Buy is a great company? Not particularly so, because Best Buy has a lot of competition. Amazon is a big competitor. Walmart's a big competitor. People aren't buying movies anymore. People aren't buying CDs. You can get your computer online. You know, there's not a lot of reason to go to Best Buy anymore, unless you want to look and touch and feel things. I know a lot of people will go and look and see what they want at the store and then go online and buy it. Right? I'm sure you all have done the same sort of thing. So Best Buy is in trouble as well, but they have not declared bankruptcy. Okay, so Best Buy has shown this beta here of 3.24. Okay, so that is, we had RadioShack. So we had Amazon had a beta of 1.4. We have Best Buy has a beta of 3.24. And so looking at that, what do we think RadioShack's beta is going to end up being? Do we think it's going to be lower than Amazon, in between Amazon and Best Buy, or higher than Best Buy? Well, it should be higher than Best Buy. Why? Because RadioShack actually went bankrupt. Okay, so there's a really low chance that the company is going to be worth anything. Okay, so the company goes bankrupt. What do we think is actually bankrupt? What should happen to the price of the shares? They should really fall. Okay, so when we go and look at RadioShack here, okay, is it RadioShack? It's not even really doing a whole lot of trading here. We have a beta. With RadioShack, we have a beta now of 4.03. That is an astronomical beta. With that really high beta, that means that our required return is going to be well over 25%. Okay, it's probably even higher than that because they are in bankruptcy. They are trying to figure it out. And they're showing a price now of 24 cents. Okay, so the reason it's at 24 cents and not at 0 is that they think that there might be a little bit left over for the shareholders, but probably not very much. Okay, so the key points here that we're looking at is that when we have more risk, that is going to increase our beta. Right? When we think this company is going to go bankrupt, increasing our beta, which then is going to increase the required return, which is therefore going to drive the price down. All right? All right.